Joining us now, we want to bring in Dryden Pence, Chief Investment Officer of Pence Capital Management. Today, we've got a lot of focus on the tech sector because we're seeing the buy the dip crowd kind of come out in force, Dryden. It's good to see you, by the way. After that sell-off that we saw on Friday, worst sell-off since April 2025. You remember what was happening in April of 2025. But on Friday, it wasn't about tariffs. But again, the buy the dip crowd came in quick. It's information technology that's keeping us higher. What's your take when you think about today? Are you surprised by how fast investors are getting back in?
No, I'm not, Diana. Thank you it's good to see you as well. Not worried about that at all. I mean, you get these moments of hiccups and overreactions to various things, but the fundamental drivers of what's driving the market, of AI and the economy and the relative strength, all of those things, people move back in because, and we've been saying now for over a year, buy chips on dips, because this is the thing that's driving increased labor productivity. That drives earnings, and earnings are robust. The economy seems to be robust in spite of all the geopolitical events, and I think that we're continuing to move forward. So not surprised that it's recovered so quickly. We actually think these are like little hiccups, and we're moving forward to a very strong year and continue to be driven by AI. AI is not paying attention to oil, and I think that that's an important issue.
I want to dive into some members of the Mag 7 that I know were, on your watch list. We were just talking about Apple. They, of course, have their Worldwide Developers Conference today, but you've got your eye on some other members of the Mag 7, although some would say, the moniker doesn't apply across the group anymore. But Alphabet, Google, let's talk about that one. It's under some pressure today amid, the buy the dip crowd. What are your views on Alphabet, Google now?
Still very strong. I mean, the big thing is when you take a look at Alphabet, you have roughly, they control search. Everybody's using them all the time. And as they begin to have greater AI integration in what they're doing, this absolute dependence that people have is only going to expand. So we continue to see continuing to have expanded investment in the future. That's important. Companies were buying back all their stock over the last couple of years. Now they're issuing stock because they've got a better place to go. They're going to invest in the future of labor productivity, in the future of U.S. economy. So we like to see this issuance. We like to see this money being invested in the future. And because 90+% of everybody's using Google all the time, it's going to be integrated in everything you do. And so we only see this as growing tremendously. We see their earnings expectations only going up. And we think that they're going to continue to capture dominant pieces of this market. So again, it's something that we are very favorable on because they're so absolutely dominant in everything we do.
Okay, let's talk about what hasn't been dominant recently. We'll start out with Meta. Microsoft's been making a little bit of a comeback, but let's start with Meta. So Meta is under a little bit of pressure as well today. I mean, we're down below 600 right now. It's been a long time since it's seen levels like $700 in terms of where shares have been performing. It says it wants to go to the market and tap the market, raise some debt raises to finance its AI ambitions. What's your thought on Meta and where it goes from here?
Meta has been behind. They really have kind of lagged behind the other companies in their AI investments. They've got some catching up to do. I think across the sector here, what's important is the risk of over-investing in AI development is much, much less than the risk of under-investing. You over-invest, the market's going to catch up to you with rapid adoption. You under-invest, you get left behind and could be left behind permanently. So Meta's behind. They're going to have to make these investments. They need to catch up. Their superintelligence unit, they're beginning to integrate that. They're beginning to move forward. They're expected to grow earnings at about 30%, which is really good, and we like that. But they're going to have to continue to make greater investments in the parts of the hyperscaling and parts of this market that's working. I mean, they have 20% of all the digital ad spend, only second to Google, but they really need to focus and catch up. And so I'm actually liking the idea that they were going to tap equity markets. I don't think they have yet, but because it's what do you do with the money? if you're doing something with the money that increases labor productivity or increases your ability to dominate in your market, we like to see those investments. And that's where companies, again, fewer companies we used to 30 billion a quarter or something in buybacks. Now it's way down to 8, and now companies are tapping equity markets to invest in the future. And I like to see that. I think that's more important. And so we're positive on it. They've got a lot of work to do to catch up, though.
Okay, they have a lot of work to do to catch up. Recently, Microsoft had been staging a little bit of a recovery, but again, it's taken another hit. It's out of bear market territory. There are some who say it should not have been caught up in the SaaS apocalypse, but there are some who say, yes, it should have been. What's your view on Microsoft now?
95% of the Fortune 500 companies use Microsoft. Azure is beginning to really kind of take off and get in. They've got, exceeding 20 million paid seats, and it's increasing. Also, the Copilot has got 20 million paid seats, and it's increasing like 200% a year. So the important point of that is you're so dominant in what businesses are doing. As businesses begin to adopt this new environment of this technological development, Microsoft is going to be embedded in that. It's going to be far easier to find the right Microsoft thing, even if it's suboptimal maybe to a few others, than it is to kind of make a complete change. So as they continue to do this, we see them only becoming more dominant over time. Now, the issue about tapping equity markets and things like that, again, I like that, because while people that are trading and trying to say exactly what they're going to do on PEs and stuff like that, the E is growing, earnings are growing, and anything that one can do to increase earnings and make that investment, I like to see. And the reason why is the market is actually a little cheaper now than it was a while back, because earnings continue to grow rapidly, and that's what we're going to focus on.
So the E is it helps justify where the P is right now. Dryden, let me ask you this. It feels like volatility tied to the geopolitical tensions in the Middle East is taking a little bit more of a backseat now. Do you think that makes sense?
I think so. I mean, at some point, we're going to get into a resolution on the Middle East. The bottom line is Iran needs money. The world needs oil. And in the end, economics always beats politics. And so I think if we just kind of work through this, give it a little time, we're going to find the Straits of Hormuz open up. We're going to find that we're not as dependent 2 or 3 years from now as we are today, because people are going to find ways to get around this choke point or not be so vulnerable to the choke point. I mean, pipelines work. The Saudis have proven that. And so I think that we're probably between now and the next 60, 90 days, they're going to have resolved this to some extent. I don't think traffic ever gets back to what it was. But I think as far as oil prices are concerned, we're going to be a situation where we're going to be back below 80. And I think that that's going to work out well for everybody. So geopolitical hits about a 45-day round trip to the market on average. And so we kind of tend to look through that. And again, AI doesn't care that much about oil.
That's a great point. That is an excellent point, and I like the sounds of lower oil prices as a consumer. I started feeling better this weekend when the gas price was getting closer to $4. Thank you, Dryden. That's Dryden Pence. He is the Chief Investment Officer of Pence Capital Management. We appreciate your time today, Dryden. Coming up.